Welcome back to Mid-Cap Radar. Well, the first management on the show is Raymond. Remember, Raymond Realty D-Street debut is scheduled on July 1st. It plans to launch 14,000 crore rupees housing projects in FY26. We are joined by Amit Agarwal, who is the Group CFO at Raymond, to discuss more. Thank you so much, Mr. Agarwal, for joining us. Well, first up, Raymond Realty lists next Tuesday. Quite a lot of expectations from the street. Take us through the key details of that particular entity. We understand, you have almost 6 projects lined up. So what is the total GDV of those projects? What is completely belonging to the Raymond stable? And what is being done via the JDA route?
Thank you for having me on your show. Friend, look, Raymond Realty has got 2 large verticals of the business. One, the 100-acre land, which is owned by Raymond Realty, which we are developing as we speak today. Of that, 40 acres is currently under development, and the balance 60 acre would get developed over the next few years. So that is one revenue stream for the business. The second revenue stream is primarily the JDA projects, and these JDA projects, we have already signed 6 JDA projects, which is almost 14,000. So put together between the two is almost 40,000 crores of the gross development value. And between these 2 projects, as we speak today, 9,000 crore has been already launched, and another 5,000 to 6,000 crores we plan to launch in this year. So thereafter, what happens, everything keeps on getting launched one after the other years, and we continue to evaluate more and more JDA projects because the Thane land is a finite land. So in order to have a growth of the business, we continue to do JDAs in MMR region. And if I look at it, as far as the JDAs, there are enough and more opportunities coming on our way. And we have evaluated more than 600 projects in order to sign up for the 6. So we are very cautious and careful in which JDAs we want to get into and what is the right project which fits in our scheme of things and the fundamentals. That's the way the business.
Sure. Mr. Agarwal, this is Vamakshi joining in. Now, if I'm not wrong, in your outlook for FY26, you've said that you're expecting 20 to 25% growth in your booking value. So roughly back of the envelope calculation suggests that the booking value would come up to roughly 3,000 crores. So isn't this a modest, growth guidance, and I mean, just would like to understand from you, is this a function of the projects lined up, or do you see some softening of demand that is taking place?
Actually, if you ask about the demand, I think we have seen a decent demand. And even as late as in the month of June, we have seen very good bookings. Actually, what you're seeing a little bit pressure is absolutely in the top end luxury segment. If I look at the affordable luxury where we operate 99% of our business, there we have not really seen any kind of a dip in the demand. Second thing, it is the lifestyle which we sell. It is not really just an apartment. And I think that is one of the reasons when we launch our project, the day one, we get a very, very good bookings. And if you see across over the projects which we have launched so far, we have sold most of the projects anything between 65% to 97, 98%. So therefore, we have not seen any way in our projects, there is a weakness in demand. Second thing, when you're talking about a projection, when we are talking about 20 to 25% growth, the fundamental reason for that is that we want to be very clear that this is a minimum which we know that we will be able to deliver. And beyond that, as we continue to launch the projects, the bookings will come. So this is the minimum, so to speak, that we are 101% assured that this is going to happen. And if you look at the demonstration of our performance, between 25 revenue to 26 revenue, there's already a 46% growth. So the company has been able to demonstrate a significant growth and improvement in all across parameters.
Understood that. For the next couple of years, 50% of the annual pre-sales is targeted from JDAs. So the first question is, how do you fund these JDAs? What is the funding requirement from Raymond's end? How does the interest rate differ compared to other developers? And what does it mean for EBITDA margins? I mean, own land versus JDAs, what is the EBITDA margin differential?
Look, first of all, when we talk about, you asked 2 questions, one about the funding and about the margin. Let me talk first about the funding. If we do our JDA model is very simple mechanics where our philosophy whether it is our own land or a JDA project, is sell fast, construct fast, and collect fast. Every project in Mumbai MMR in India is on a construction linked payment. So if you have sold the inventory, you are bound to get the collections. So I'll give you a simple example. On a 2,000 crore project, your peak cash funding requirement is in the range of 450 odd crores, of which the 250% of that is 225, 230 crores comes from the Raymond equity, and the 230 is a project finance debt. Project debt, we are able to get it from the various Indian banks, which they are very, very supportive. And at the end of the day, the Raymond Group has a very strong, credible history with banking relationships. And therefore, we are having no challenges in getting that funding. And that also, because we are able to complete the project in a faster pace, our peak cash requirement is on the 18th month in a cycle of 60 months. And by 32nd, 33rd month, the project starts to generate cash so that the debt starts.
And a word on the margins, sir?
Sorry?
And a word on the EBITDA margins?
So the EBITDA margin, again, for different projects, it will be different, because at the end of the day, each project will have a very different structure. There will be a different margin profile, different sharing of the land which you need to do in terms of the square feet you need to give to the tenants, in terms of the people who are there who have to give the land.
Sure.
So it will be very different. But broadly, the way we have defined is across the board, we will not be entertaining a project which will be below a 20% EBITDA margin, and all our projects should deliver minimum of 20-22% IRR.
All right. Thank you so much for that, Mr. Agarwal, for joining in with CNBC TV18. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is only just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.